Hello and welcome to this video on bonds. In this video, we will explain what bonds are, how they work, and why you might want to invest in them. Bonds are a type of investment that allows you to lend money to a company or a government for a set period of time. In return, you receive regular interest payments and get your money back at the end of the bond's term. This is why bonds are also called fixed income securities. They provide you with a fixed income stream. Bonds are issued by different entities for different purposes. For example, companies may issue bonds to raise money for expansion, research, or acquisitions. Governments may issue bonds to fund public projects, such as infrastructure, education, or defense. Bonds have different characteristics that affect their price and risk. Some of these characteristics are the face value. This is the amount of money that the bond issuer promises to pay back at maturity. The coupon rate. This is the annual interest rate that the bond issuer pays to the bondholder. The maturity date. This is the date when the bond issuer repays the face value to the bondholder. There are usually two types that come to mind when speaking of bonds: coupon bonds and zero coupon bonds. A coupon bond pays periodic interest to the bondholder at a fixed percentage of the bond's face value. This interest is known as the coupon and is typically paid annually or semi-annually. Pause the video if needed to understand how the bond price is calculated. A zero coupon bond does not pay any interest. Instead, it is sold at a discount to its face value and redeemed at its par value at maturity. The difference between the purchase price and the face value represents the interest earned on the bond. Bonds can be classified into different categories based on the mentioned characteristics. Treasury bonds are issued by the U.S. government and are considered very safe and liquid. Corporate bonds are issued by companies and have higher yields but also higher risks than treasury bonds. Municipal bonds are issued by state and local governments and may offer tax advantages. Junk bonds are issued by companies with low credit ratings and have very high yields but also very high risks of default. Investing in bonds can provide you with several benefits, such as diversification. Bonds can help you diversify your portfolio by reducing its overall volatility and exposure to stock market fluctuations. Passive income is another benefit. Bonds can provide you with a steady source of income that can supplement your other sources of income or help you achieve your financial goals. Bonds can help with capital preservation. By returning your principal amount at maturity or earlier if you sell them at a profit, you can preserve capital and protect your wealth more wisely. Investing in bonds also involves some risks. First, we have interest rate risk. Bond prices move inversely with interest rates, so if interest rates rise, the price of the bond falls. And if interest rates fall, the bond prices increases. Reinvestment risk. This is the risk of having to reinvest your interest payments or principal amount at a lower rate than what you originally earned. For example, if you buy a 10-year bond with a 5% coupon rate and interest rates drop to 3% after 5 years, you will have to reinvest your interest payments and half of your principal amount at a lower rate for the remaining 5 years. Inflation risk. This is the risk of losing purchasing power due to inflation. For example, if you buy a 10-year bond with a 3% coupon rate and inflation rises to 4% per year, your real return will be negative because inflation will erode the value of your future cash flows. Credit risk. This is the risk of losing money due to default or downgrade of the bond issuer. If you buy a corporate bond and the company goes bankrupt or fails to pay its interest on time, you may lose part or all of your investment. Or if the company's credit rating is lowered by rating agencies, its bond price may fall because investors will demand a higher yield to hold it. Economic conditions. When economic conditions improve, bond prices may fall because investors prefer riskier assets such as stocks. When economic conditions worsen, bond prices may rise because investors seek safer assets such as bonds. As you can see, bonds are a complex and diverse type of investment that offer more opportunities. Before investing in bonds, you should understand their features, benefits, and risks, as well as your own financial objectives, risk tolerance, and time horizon. Thanks for watching.